Good afternoon, and welcome to the 2015 Teller Line Study webinar, brought to you by FMSI. Thank you for joining us. My name is Chad Davis, Senior Vice President of Marketing at FMSI, and I will be the moderator for today's call. Today we're going to open things up and first talk about the current state of the branch. We're then going to move on and discuss the impact of online and mobile on the branch. Following that, we're going to have a conversation about a more sales-centric branch approach. And then we're going to review the 2015 Teller Line trends. After that, we're going to take a closer look with one of FMSI's clients, Credit Union of America, and Eileen Phelps is going to be speaking on that front. Transaction type occurrences in the branch will be the next discussion after that. We're then going to move on to maximizing the branch investment through technology. And at the very end, we're going to have an open discussion, including a Q&A session. You will have the opportunity to ask questions throughout the webinar. On the right side of your screen on the control panel, there is an area for you to type questions. We will answer questions immediately following the presentation. Today's speakers include Gordon Williams, the FMSI EVP of Business Development, Eileen Phelps, the Credit Union of America SVP Chief Services Officer, and myself, Chad Davis, the FMSI VP of Marketing, as the moderator. At this point, I'm going to pass it over to Gordon Williams, who will be taking you through today's presentation. Gordon?
Thank you very much, Chad, and thank you to everyone that has taken the time to join us. The purpose of our presentation today is to talk more about the 2015 Teller Line study that FMSI published recently. It's no secret to anyone inside the industry that the branching world that we have always known is changing, but the rate at which the branch is changing is what is truly fascinating. To begin framing some of the numbers that we'll discuss today, let's start off by talking about what has been taking place in the branching world over the last few years. Up on the screen, if you notice the bar graph in the top left corner, you'll see that it appears the market has been correcting itself from what many have said is an over-branched branch environment. Now, there could be a number of factors at play here, including branch rationalization strategies that minimize unprofitable offices, and also offices that were closed due to mergers, acquisitions, or even failures. While the market has been correcting itself, the ratio of population to branches has continued to decline from 9,340 in 1970 to 2,970 in 2014. While the population per branch is at the lowest we've seen in the last 40 years, this also comes at a time where customers and members have never been less branch dependent. It's interesting to consider just how much your customers and members need the brick and mortar office today compared with years past. Online and mobile channels, as you see on the screen, are on the rise with no signs of letting up. Going beyond simplistic transactions like deposits, transfers, and payments, online account opening is also impacting just how often a customer or member walks into your branch to be served as well. While a large branch footprint or lengthy hours of operation used to be a competitive advantage in the past, this is no longer a significant differentiator when members and customers evaluate their banking options. While some would say technology will eventually lead to the death of branch banking, FMSI predicts that a complete transformation of the branch, with retail locations ultimately becoming much more sales-centric than deposit-centric, is the future of banking and will always be relevant. The million-dollar question will be how to operate this new branch design as efficient as possible while creating a unique experience that is not easily replicable. Organizations that include sales-centric branches in their retail footprints that appeal to the growing segment of heavy digital users will likely have a leg up to the competition in the years to come. Whether it's a branch in a more urban setting today or a branch in a rural area 10 years from now, these more sales-centric branches can look and operate drastically different than deposit-centric offices of today. A recent FMSI white paper, Millennials' Relationship with the Branch, included multiple surveys citing heavy digital users seeking out the branch for advice on financial products and services, or what FMSI likes to call a higher quality interaction. Higher quality interactions can more likely lead to closed product sales and additional wallet share, which is exactly the type of exchange institutions desire between account holders and the branch office. Through employing a deliberate, systematic approach, leveraging the right blend of technologies, training and architectural designs, organizations are able to make significant strides toward creating profitable sales-centric branches today, and most importantly, sustainable locations that remain viable in the future. The next portion of our presentation is really going to start diving into the actual numbers from the Teller Line study. The first number we'll talk about today is the decline that branches have seen in volume over the last 23 years. Since 1992, branches have drastically changed their production output on a transaction front from an average of 11,700 transactions per month to 6,400 transactions per month. Like we discussed earlier, this environment has really been created by growth and innovation by organizations. You've probably opened more branches over that time period and also put more technology in your customers' and members' hands that has encouraged them to walk through your doors less. While branches have seen a lot less activity taking place, at the same time, the amount organizations are investing in their employees and salary and benefit rates has grown substantially over the same 23-year time period. From an average of $8.85 an hour in 1992 up to the current average of $16.82 per hour for the frontline teller workforce, organizations are paying a higher amount to employees that are facilitating the remaining transactions your customers and members are needing handled. This next slide tells a story that organizations have not been able to reduce their workforce at the same rate transactions have declined. As you can see, there has been an almost 20% decrease in employee efficiency since 1992. What's interesting about this number is many organizations have invested in technology from smart ATMs to recyclers to interactive teller machines that are a significant investment. Oftentimes, the investment in those technologies is approved because there will be a substantial ROI by removing salaried employees that used to handle these previously labor-intensive activities. In many organizations, the investment in technology is made with the hope of reducing salary expenses with the purchase, but management teams are left making decisions from their gut feelings about where employees could potentially be removed. Since decisions are based on gut feelings and not in fact, a business case to not replace employees never really gets off the ground, resulting in a much higher unit labor cost, as you'll see on the next screen. The labor cost per transaction that organizations are faced with today averages out around $1.12 for every transaction being processed within the branch walls. This 133% increase is a huge hurdle for organizations to overcome. Have you thought about how you can remain competitive in the future if your cost for processing a transaction is potentially twice the amount your competition down the road is paying? There is a much more interesting story that gets told if we start segmenting the data between credit unions and community banks, and that's what we'll look at over these next few slides. While community banks have seen a lower percentage of transactions leave the branch since 2011 compared with credit unions, it's really quite opening to also compare the average volume between the two market segments. Overall, credit unions still have a much higher amount of transaction activity taking place in the branches than what the community banks are seeing in current times. While the percentage change in transaction activity is very different between the two market segments, notice how similar the change in cost per transaction compares between 2011 and 2015. While the cost per transaction is higher for community banks than it is in credit unions, the percentage increase is almost identical, with credit unions at a 13.7% labor cost increase and banks at a 13.9% labor cost increase. At the end of the day, both segments have seen their overall transactional efficiency decrease, with credit unions seeing a 7% decrease in transactional efficiency and community banks seeing a 3% decrease in transactional efficiency. While this story is really focusing on the macro view that we are seeing amongst our client base, what we would like to do next is take a more micro view and turn the presentation over to Eileen Phelps to speak to what she has seen take place at Credit Union of America over the last couple years. Eileen?
Thank you, Gordon. And Chad, thank you for asking me to participate today. Credit Union of America is located in Wichita, Kansas. We have just over $623 million in assets, 12 locations, and we're approaching 57,000 members. Interestingly, we have very active online banking users, and our mobile users are quickly approaching the level of the online banking users. We launched our mobile platform in September of 2013 and anticipated it would grow, but it grew exponentially. Currently, we're accepting about 5,400 checks a month by remote deposit capture, and we're still doing, however, over 90,000 teller transactions monthly. This is a little bit of a surprise to us with the growth in the other avenues that our members enjoy, the digital avenues. They still hit that teller line. We started with FMSI in July, actively using their teller management system of 2013. We still have had a teller growth of 16%. Through that, it's been extremely important for us to manage our resources. Using the FMSI platform, we've been able to actually reduce the number of FTEs by 2. Our cost per transaction in July of 2013 was $1.04 per transaction. Just last month, in April of 2015, our transaction cost was 92 cents per transaction. This equals, for Credit Union of America, savings of over $100,000 a year in teller wages and benefits. During that time, we've reduced our excess waiting for work from 34% of idle time down to 24.8%. Our part-time utilization has gone from about 55% up to 58%. A couple of comments I'll make concerning this is that due to our physical branch structure at this time, we have made a service decision that we won't, until we restructure these branches, we'll still probably overutilize staffing, but as you can see, we've made a vast improvement and reduction. Some of the things that I would say have led to our success is centralizing the teller scheduling. I can tell you there are 2 things that will frighten a branch manager more than just about anything else, and that's 1, telling them that you're going to potentially reduce their teller staff, and 2, that somebody else may schedule it for them. It's very important to the success of your program to get buy-in from your branch managers. We approached it this way, and eventually we did suggest to them that let's just take this away from you and let's do some centralized scheduling. We promise you'll never be short. We promise we'll make sure tellers are where they need to be. And that really helped us to get buy-in from them and for our program to work well for us. The part-time staff in high-volume branches, we now have 1 full-time teller at our high-volume branches. High-volume branches for us are branches that are doing between 15 and 22,000 transactions a month. So, again, just 1 full-time teller in that, and then we utilize part-time tellers for the rest of that staffing so we can address peak times and not have a full-time teller there just clocking her 40 hours when we really don't need a person helping and assisting members. We are also in our lower volume branches, we've begun utilizing the universal staff member. A universal staff member, you can call it any number of things, a member service representative, a financial services representative, but this individual can actually hop back and forth between roles. When they're finished opening an account for a member, they simply walk them over and then assist them with their deposit. Or if there are people that are needing teller transactions, they do that and float back and forth between the 2 roles. after our study and looking at our transaction volumes and trends, it was really obvious to us that we had, in a effort to create consistency in our branches, all of our branches have the same hours. Open those drive-thrus at 7:30 and keep them open until 6 o'clock at night. Lobbies opened at 9 and remained open until 6 o'clock in the evening. By looking at the actual transactions taking place, we realized that our members did not need that. They weren't even utilizing that accessibility. Because we tend to do things in a fashion that is a bit incremental, we decided to not open 6 of our branches until 9 a.m. and leave 4 branches in the Wichita Metro. We continue to open those at 7:30, and then we have a remote branch that's high volume all the time, and that we kept open. Interestingly enough, our members, it was a non-event for them. They were well informed, but it was a non-event. That equated to $68,000 in additional savings in our human resource expense. In 2015, we are just next month opening a new branch model, and this branch will utilize virtually all universal staff. We will hire 1 part-time teller only for the branch. There will be a drive-through, but aside from that, there will be no traditional teller line in this particular branch. We do have a branch in this community. It's a bedroom community of Wichita, and the current transactions that are being done in a very small retail space will equate well when we move to this freestanding branch. So we're excited about that. When we see how it performs, then our plan is to look back at these existing branches that the physical structure of the branch doesn't work well for that model, and invest money in refurbishing those branches so that we can better serve our members. And I think that's about the crux of our story, Gordon. I'll just turn it back over to you.
Thank you very much for sharing your story this afternoon, Eileen. We really appreciate it. One new thing that we decided to focus on during our teller line study in 2015 is to take a closer look at the kind of transactions that are still taking place within the branches. When our clients submit their transaction data to FMSI, oftentimes they include a transaction code to provide the insight as to what the specific transaction activity was that actually took place. When we began looking at this data, it was interesting to see what the top 5 most common transaction types were within the branches. Interestingly enough, the bulk of activity included basic deposits involving checks at about 26%, cash withdrawals at 22%, cash deposits at 11%, loan payments at 5%, and then bulk deposits at 4%. The time of day these activities took place is also revealing, as the afternoon had a much greater percent of the volume taking place than the morning. If organizations staffed their branches the same at 9:30 a.m. as they did at 3:30 p.m., what do you think would happen to employee efficiency and that resulting cost per transaction? As we conclude our presentation this afternoon, we're going to talk a little bit about maximizing the branch investment through technology. When we talk about looking at what a branch needs, you have the ability to really harness the power of your data by using technology that can help your branches best align staff to the future activity of your consumers, that allows you to see the resulting cost decrease but service actually increase. The picture you see here on the screen is a graphical representation of a schedule for a specific day in a branch office. It is important to highlight the different shifts that you're seeing on the teller line and across the workforce. With forecasted transaction volumes guiding the schedules that are created, the institution knows to put part-time staff on the teller line at very specific times, which results in a much more efficient use of the teller investment. As far as a management tip goes along with scheduling, once you're forecasting your future consumer demand and using technology to automate that scheduling process, you really find yourself in a position where you're empowered to begin time blocking your employees' schedules for secondary duties. Notice on the screen how employees have time blocked off for ATM processing and other activities. This allows for a streamlined approach that helps branches to schedule all that is needed while best utilizing the investment you have also made in your personnel. One other way to maximize your branch investment with technology is to put all of the data you have to work for you. With all of the data that exists in your core systems, it can be used to calculate FTE needs in the future for your offices. The chart on this slide represents a branch's FTE forecast based on volume per hour and day of week. Many institutions use charts like the one shown here to help determine how many FTEs they need at their branch per hour. As an example, if a branch schedule has 4 tellers scheduled to work at 8 o'clock in the morning on Monday, July 2nd, they might consider having one of these tellers come in at 9 o'clock instead. An area where this type of information can be extremely beneficial to have is around forecasting the need for your universal associates as well, and then also measuring their actual performance. On this next management tip that you see on the screen, you're actually able to see an example of what a forecast would look like for a universal associate when you leverage sales and service activity information in conjunction with transactional information. Notice how each hour of the day on the screen identifies the number of FTEs needed for sales and service activities, as well as transactional activities. Scheduling your universal associates to your consumer demand will guarantee that you deliver the service your customers and members expect, which allows you to really strengthen the relationship that you have with them. If you're sitting there wondering how to really measure the sales and service activities that your employees are responsible for, you're not alone. Many organizations have struggled with understanding just how many conversations employees are having around products or services and how much time those actually take. There is technology available to the market that allows you to measure all of these activities. As your members and customers come into an office, they can be signed into the technology, and the system will actually begin tracking wait times of your account holders, but then also track the service time and the type of activity that actually is taking place. This technology helps organizations to truly understand everything that is happening within the branch office and really empowers you as a manager to create an environment of accountability around your sales growth and your service offerings. One final way that organizations can really maximize the branch investment with technology is to consider offering appointments to your members and to your customers in your branch offices. From reserving movie theater seats to ordering pizza, consumers are accustomed to getting what they want through their smartphones, and fulfilling their banking needs really should be no different. Organizations have made considerable progress in accommodating what account holders are asking for, but other industries are setting the bar higher, seemingly every day. If you look at salons, barber shops, car repair shops, and other service-oriented retail stores, including some banks and credit unions today, they're now offering the ability for consumers to set appointments through websites or smartphone applications. If your account holders are not asking for this time-saving and convenient capability now, they certainly will be soon. So let us know if you'd like to learn more about FMSI's Omnix Appointment Concierge. Historically, institutions have not had to worry about staffing the branches to a declining volume of transactions because branch activities were always growing, in part to a growing population and economy. Instead, they were looking where to add new branches as new housing developments were popping up on every corner. Today's environment has changed greatly from those days of the past, and the trends in this study suggest the market is now over-branched, a situation that many institutions have mostly ignored. We hope that this webinar has helped provide insight on how branches are evolving and identify the issues that executives and first-line management face in today's economic environment. Next, I'm going to turn the presentation back over to Chad, who will be taking questions from our audience. Chad?
Thanks, Gordon. And thank you very much to Eileen for sharing her thoughts today as well. Both the recording of this webinar and the PDF of this PowerPoint will be available on our website. I will email a direct link to this webpage to everyone on this call. Now let's get to the Q&A. We've had several questions come in throughout the webinar, and we're going to start off with one for Gordon here in a second. Just a note, we might not get to all the questions on this webinar live, but we will make sure to follow up with everybody's question on an individual basis. So the first question, Gordon, is for you. How is your staffing forecast calculated?
Well, that's a good question. When we start looking at the staffing forecast and how we calculate that, what we're doing is we're actually using data from the core systems that exist at credit unions and community banks. So the data that we're looking at includes, a date and time stamp, a branch identifier, and employee identifier that allows us to really key in on when customers and members are coming through the doors. What we can then start doing is using that to associate it with the specific day of the week or the date of the month or the time it is before or after a holiday to make sure that we're taking into account all of the different variables that impact how your members and customers transact with the branches.
All right, good stuff. Got another question here. This one's for Eileen. Eileen, how do you track and manage branch service?
We do surveys for online as well as by email for each transaction and interaction that takes place with our phone center staff, our teller staff, and our lobby sales staff.
Good stuff. Well, good. Well, we'll go ahead and get to the next question then. This one's for you, Gordon. What % of my teller labor hours worked should be by part-timers?
That's a wonderful question. The good part of that question is there's no exact right or wrong answer. I think you saw with Eileen's numbers earlier that they're sitting in the high 50% with part-time utilization. The two things we know about part-time utilization is that if you're at 0%, it's probably not accurate, and if you're at 100%, it's also probably not accurate. What we've been able to find is that if we look at our top 10 clients, those that really are getting the most efficiency out of their workforce, usually their part-time utilization comes in somewhere between 35 and 45% on an ongoing basis. So while there is no right or wrong answer on that front, I think there's a strong relationship between being there and getting the most efficiency out of your workforce.
All righty. Good stuff. Looks like we have time for a couple more questions. Here, this next one's for you, Eileen. This person asks, can you elaborate more on implementing reduced branch hours, and how did you communicate them to your account holders?
Well, the first thing that I needed was good data. We are a very data-driven organization, and FMFI helped us to accumulate and track that data. I then took that and got buy-in from my management team, and then, of course, it did go to board for approval. I think that's really important when you then go forward to staff so that they know the support and the thought process that went into that. Then beyond that, we had a huge campaign for our membership. We created buck slips that went out in every drive-through window because the hours that we were shortening were only affecting drive-through members. And members were reminded. It was on our website. It was on our online banking banner when they logged in. Just every touch point that we could. We did that for about 45 days, and then honestly, it was a non-event for us. We had literally one member that made comments that they had gone to the wrong branch, were instructed to go to the next closest branch, and they were able to complete their transaction. So for us, I just think the thought process and the planning made it a smooth transition.
Yeah, so an all-out communication blitz and doing it the right way. So it sounds like that worked great for you guys. All right, one last question here. This one's going to be for Gordon. Gordon, what kind of feedback have your clients received from their account holders when they consolidate low-volume branches? I guess, what some of the other clients that FMSI has, what are they saying as well?
Sure, it's a really good question. I think it honestly goes in line with what Eileen was sharing on the hours of operation front. Is there a lot of pushback on hours when there's communication as to what's happening with a given office, whether it's reducing the hours that are there or consolidating completely, and some of the reasons behind it as well. I think the one thing that members and customers really appreciate is having some level of insight into why it's happening and what the positive side effect of that is. So again, overall, we've heard for the most part that it's a non-event when some of these decisions are made, as long as the communication that goes out to members and customers alike is very clear as to the reasons and what can be expected in the future around how they transact business with a credit union or with a bank.
All right. Well, sounds good. Well, that's all the time we have for today. A special thanks to Eileen for joining us today, and thank you to all of you for joining us as well. And if you have any additional questions, please reach out. And like I said earlier, the couple questions that we didn't make it to, we'll certainly reach out and on an individual basis to answer those for you. All right. Thanks again, everybody, and have a great day. Bye-bye.